Hello everyone and welcome to today's webinar, Finance for Non-Finance Leaders with Michael Gummery. My name is Kevin and I look forward to hosting today's creative webinar session. I would like to start by acknowledging the traditional owners of the countries throughout Australia, including where you are connecting from today. I myself are coming to you from the lands of the Gummery people of the Eora Nation. I pay my deep respect to elders both past, present and emerging. And if you like, please share and acknowledge the country that you are coming from in the chat feature of Zoom. Currently on screen is a blue PowerPoint holding slide with some text and video boxes with our guest speaker and Auslan interpreter. I am a man in my early 40s with fair skin, brown eyes and dark brown hair. And today I'm wearing a blue shirt in front of a black backdrop. In fact, I nearly said young in my early 30s. I nearly slipped up there. Welcome to today's session, everyone. These sessions have been designed and produced for you. We hope to provide support and resources and a sense of collective reimagining of our futures and our practices during these uncertain times. I'm so encouraged again to see many of you join these sessions, and I congratulate you for making some time to learn and to share and to explore. I invite you to continue to join us for future sessions. Before I hand over to Michael, introduce you to him, just a quick reminder that there's a range of grant opportunities that are currently open at the Australia Council and that we are accepting applications. The next closing date is on the 1st of September, which of course is not very far away. There's our usual rounds around applications for arts projects for individuals and groups, for organisations, the National Arts and Disability Awards, the Australia Council Awards, and also the fellowships are the opportunities closing on the 1st of September. Before we kick off, again, a couple of housekeeping items and to recap a few. Firstly, live captioning is available via Zoom, which you can activate by clicking on the CC button at the bottom of your screen. And of course, if you use a mobile device, it's most probably at the top. Today's session will be recorded and we will send everyone a copy of this next week. We will also be hosting a short Q&A at the end of Michael's session and invite you to submit any questions in the Q&A feature, which is at the bottom of the screen. And encourage you to do so in the Q&A, not in the comments, just in case we miss any. So, okay, it's with great pleasure to introduce you to our guest today. Currently on screen is a PowerPoint slide to introduce our guest speaker. There's a title to introduce Michael Gummery next to a headshot, a square cropped image of a man with fair skin, dark hair, smiling at the camera. He's wearing a blue jacket and a white coloured shirt in front of a blurry background. Michael is a partner at Melbourne-based advisory and accounting firm HLB Mann Judd. And Michael has a long history in technical accounting and auditing with a sound knowledge and understanding of both the private, public and the not-profit sector. Michael has worked with diverse clients over his careers, ranging from small and startups to listed multinational corporations. Michael is known for taking a practical approach to accounting. And that means Michael is the best person to run today's session with us. For many arts managers, our exposure and learning to finance and reporting is done on the job. Many of us produce budgets for projects, for funding, or produce reports for our boards. So today is a quick review and a pause to learn about some of those key concepts that's important for us to be able to make sense of some of the key accounting concepts. So it's great that Michael is joining us today to guide us through some of that thinking. Michael, thanks for joining us today and for sharing your knowledge and thoughts with us. We really do appreciate your time. I'll hand over to you now, and I think you've got some slides to share with us, and then we'll get cracking.
Sure. Thanks very much, Kevin, for the introduction, and thanks for having me. Let me just share my screen with you all. So hopefully you can all see that. Is that all okay? Can you, Kevin, can you see the screen okay?
If you just change the setting to, yep.
Yes.
Brilliant, that's perfect. Thank you, Michael.
Perfect. Okay, thanks very much. So hi, everyone. Thank you again for having me. So my name is Michael Gummery. I'm a man, fair-skinned in my mid-30s with ever-graying brown hair. I'm wearing a sort of reddy maroon color jumper and glasses. So as Kevin mentioned, I'm a partner at accounting firm HLB Mann Judd. I specialize in the provision of audits and technical accounting advice. And I do have a number of clients in the art sector, both in the public space and the not-for-profit space. So I do have some understanding of the sector, and especially an understanding of what a difficult time it is financially for many of you at the moment. So the topic today is finance for non-finance managers. Now, finance is obviously an extremely broad topic. So what I intend to do is actually narrow that down to something quite specific, which is financial reporting or financial statements. So I understand that most of you have perhaps limited finance experience, depending on what your exact role is in your organization. So my intention is to not assume much knowledge at all and try and really go back to basics for you. And I'll try my very best not to use too much jargon or acronyms. And if I do, I'll try my best to at least explain what those mean for you. So just to go through what the objectives of the session are, so I'm hoping at the end of this session, you'll be able to understand what a financial report is, what a financial report contains, how to read some of the main statements within a financial report. So the profit and loss statement, the balance sheet, and the cash flow statement. The difference between accrual accounting and cash accounting, and the importance of an audit or of a review on the financial report. So I guess some of you may or may not have had involvement with financial statements in your roles to date. But I think even if you don't, there's probably some benefit of getting an understanding of some of these key concepts. I think Kevin mentioned before, budget preparation, funding applications, putting information to your boards or committees. It normally requires at least some level of understanding of those core financial statements. So I'll just try and pull out some key areas from those that hopefully helps you in your role, or if you're coming across a set of financial statements for another reason. So firstly, a bit of background about financial reports. So I mentioned that I wouldn't use too much jargon. So what I'm going to try and do here is just cover off the different terms that get used for what I'm calling financial reports. You'll often hear them called financial statements, or you may hear people say annual reports, or you may hear people use the term accounts in inverted commas. They're essentially used interchangeably and sort of represent the same thing, but not necessarily always. And the annual report especially is a little bit different. So an annual report is often a sort of glossy, really well graphic designed document that a company or organization puts out on a yearly basis. It covers a whole range of topics, not just financial. So often there'll be, say, a letter from the chairman or the CEO at the beginning. There may be information on things like, how the organization has achieved its objectives, maybe what events it's put on during the year or programs it's run. Perhaps it's commitment to diversity and how it's done with that. It's how it's reduced its carbon footprint, or all sorts of information which is not necessarily financial. And then somewhere in the annual report, often right at the back, there'll be the financial statements themselves, which is the sort of financial focus area. So you might hear people use that term annual report when they're talking about the financial statements, but they're actually talking about the broader document. So just be aware that those terms get used interchangeably. So the financial report or the financial statements is really a document through which companies or organizations communicate their financial results to stakeholders. So, in the listed company space, those stakeholders, or the private company space, they're normally the shareholders of the business. But for example, for a not-for-profit organization, the stakeholders may be the public at large, or specifically the users who benefit from the services that you provide. The stakeholders could be the actual funding provider. So say, for example, the government department that's funding you, or if you've got loans, it might be the bank or another organization that's interested in your financial results. So there can be two main types of financial statements, what we call special purpose financial statements. And as the name sort of suggests, they're prepared for a special or particular purpose. And for that reason, they're often not compliant with all of the accounting standards. So the accounting standards are effectively the rules that govern how a set of accounts or financial statements get prepared. And a special purpose set of accounts is for a very particular reason, and therefore doesn't necessarily comply with them all. And that's opposed to a set of general purpose financial statements, which are fully compliant with the accounting standards. And they're typically mandatory for what are known as reporting entities, which, for example, all listed companies have to prepare general purpose financial statements. Most public sector organizations prepare general purpose financial statements, certain not-for-profits depending on the way they're governed as well. And a set of financial statements may or may not be subject to an audit or a review by an independent auditor. And I'll go on to talk about that a little bit later on in the presentation. So I guess first, just to kind of give you an overview of what the main contents of a set of financial statements are. Typically at the beginning, you'll have the director's report. Now, that won't be in all sets of accounts. Director's report would require the company to have directors, and not all organizations are set up as a company, so they don't necessarily have directors. So you may or may not see this document in a set of accounts. And sometimes you'll see something similar. So perhaps if the accounts are for a trust, you might see a trustee's report rather than a director's report, but the concept is effectively the same. And it normally gives you a summary of the operations of the organization, perhaps some information about objectives and strategies, and some sort of higher level information before you actually get into the numbers themselves. And then next, you've got what we call the primary statement. So these are the kind of main bulk of the financial information. And there's four main statements: the profit and loss statement, the balance sheet, the cash flow statement, and the statement of changes in equity. Now, you've probably heard of some or all of those statements before. They do get mentioned quite often. I'll drill down into a few of them to actually break them down in a bit more detail for you later on. And then after the primary statements, what you get is what we call the notes to the accounts, the notes to the financial statements. These typically give some general background about the organization. So they might, for example, say whether the accounts are special purpose or general purpose, which I mentioned before. They'll mention what legislation the organization is reporting under. And then what they'll often do is actually break down some of the information from the primary statements into a greater level of granularity. So, for example, in the profit and loss statement, it might mention the revenue or income that the organization has generated during the year. And then there'll be a reference to a note. And when you flick further on in the document to that particular note, it might then break down that revenue number for you. So rather than just being one number, it will break it down to say that that revenue is made up of X dollars of, say, grant income, X dollars of ticket sales, X dollars of sponsorship, or whatever other types of income the organization might have. So the notes are quite useful when you want to get a little bit more information about a particular line item. You can refer to those to get that information. And then finally, as I mentioned, the audit report or the review report, which I'll talk to a little bit later, tends to come either right at the front of the financial statements or right at the back. But you can flick to that to see the report that the auditor's given. If applicable, not all organizations do have an audit. So what I wanted to do next was sort of take you through an example of an actual set of financial statements. So on screen is the sort of cover page to the annual report for the Australia Council for the Arts. It seemed like a good example to use for you all. And as I said, like the annual report is often this kind of fancy glossy document, and this one has got a particularly nice image of someone dancing and throwing some colored powder or something into the air. So that this is the sort of annual report part, and I'll put the contents page on screen as well, because I just wanted to sort of show you what I meant about this document. So the contents page there shows lots of different sections of the annual report. For example, it's got the CEO report, funding overview, arts organizations, which is broken down into all different types: First Nations art, regional art, international art, etc. There's a section on management and accountability with sort of governance and human resource information. And then almost right at the end, which I've circled with a red circle there, is the financial statements. So that's the particular bit that I'm going to talk to try and break down into a bit more detail for you. So, and that document itself is still quite big. So I think based on this one, it's approximately 40 pages. So of course, I can't possibly talk to all of it in the time available, but I'll try and focus on some of those primary statements for you just to give a little bit more detail. So on screen is an extract from the Australia Council for the Arts Statement of Comprehensive Income. So the Statement of Comprehensive Income is also known as the profit or loss statement, and that's often abbreviated to the P&L, or sometimes also known as the income statement. So it can be confusing if you're not familiar with these types of statements, because there's 3 or 4 different names for one document there. So just be aware. I mean, you'll often hear people sort of more casually use the term P&L, but all of these terms get used interchangeably. So underneath the heading there, it mentions that the Statement of Comprehensive Income is for the period ended 30 June 2019. So I'm going to use the term profit or loss for this statement from now on, but the profit and loss statement actually covers a period of time. So in this case, it covers the period to 30 June 2019, and that's normally a year because most organizations report annually. And that's as opposed to the balance sheet, which I'll show you next, which is actually a snapshot in time, normally at the end of the year. So the balance sheet will be basically a snapshot as at close of business on the 30th of June 2019, whereas the P&L covers the whole year. So the analogy that often gets used when people are being taught accounting is the profit and loss statement is like a video. It covers a period of time, whereas the balance sheet is like a photograph. It's a snapshot at a particular point in time. So you'll see on the screen, there's 2 columns of financial info, well, 3 columns of financial information. One is the 2019 column, which is the current year financial information. And there's also a comparative column, 2018 column, which is showing you the financial information from last year. And then there's also a column for the budget for the year. So pretty much every set of accounts will have these, the 2 main columns of the current year and the prior year. And that's provided so that you can see the trend over time, or the change in those numbers from year to year. The budget column that's shown on screen is actually fairly uncommon, I would say, although it's very useful information if it is provided, because it shows you what the company was actually budgeting, as opposed to just comparing to the prior year, because prior year numbers aren't necessarily what the expectation of the current year balance would be. So there's two main sets of information in the profit and loss statement. There's the income and the expenses. So looking at income first, you'll often hear terms used like revenue or turnover or income. They all essentially mean the same thing. And it is what it says. It's the income of the organization. And it's split out by various sources. So in this instance, there's interest income, rental income, other revenue or other income, and revenue from government. And we've then got the expenses. So again, as they say, they are the expenses that were incurred by the organization over the period of the year. And they include things like employee benefits, so salaries, supplier costs, grants given in this case, and depreciation and other expenses. Now, typically in a profit and loss statement, you would expect to see the income come first and the expenditure would typically come second. In this particular profit and loss statement, it's actually the other way around, which is a little bit uncommon, but you do see it occasionally, so just be aware of that. Then at the bottom of the, or pretty much the bottom of the profit and loss statement, you can see what's called the surplus on continuing operations. So this is basically a simple function of income minus expenditure equals the surplus or the deficit for the year. It's what in a for-profit organization is known as obviously profit. So they would have income less expenses equals either profit or loss, hence the name profit or loss statement. But in the not-for-profit space, the term surplus or deficit tends to get used because not-for-profits by their definition of their name are not for profit, but of course they do try to create a surplus to invest back into the organization if they can. And I've highlighted in red on the screen the column called notes, which gives you the reference to those, the further information that exists within the financial statements. So if you wanted to look at one of those line items in more detail, you can go to that particular note and you'll find more information. So next I'll show you an example of what in this case on screen is called the statement of financial position. It's also very commonly referred to as the balance sheet. So similar to the P&L, and as with all the statements and the notes, you get the same columns, current year column, a prior year column, and for this set of accounts, the budget column. And as I mentioned before, the balance sheet is at a point in time. So in this case, it's as at 30 June 2019. So it's effectively the close of business on that day. What were the assets and liabilities of the organization? And for most organizations in Australia, the date is 30 June that's used for reporting, but not always. So you do get companies and organizations that have different, what we call year-end dates or balance dates. So the balance sheet shows a few main aspects, one of which is the assets. So these are simply the assets of the organization or the company at that point in time. So for example, what was its cash balance in its bank account at that point in time, how much money was owed to the organization by others, what we call receivables, trade receivables, and what assets did it hold? So for example, land and buildings or plant and equipment or vehicles. So all of these assets have a value and that value is shown in the balance sheet. Now, often in the balance sheet, you'll see the assets and the liabilities split between current and non-current. Now, that's not the case in this particular set of accounts. In this case, they're split between financial assets and non-financial assets, but quite commonly you'll see the split between current and non-current. So current assets are assets that are expected to be realized or available to realize within 1 year. So for example, cash or what I called trade receivables, which is money that's owed to the organization. If that's expected to be collected within a year, which typically it would, that would be a current asset. Whereas things that would be considered non-current might be things like land and buildings. So you own a building which you occupy and you're expecting to get use of that for say 30, 40 plus years. It's not a current asset, it's a non-current asset for that reason. And the same logic applies to liabilities as well. So moving on to liabilities, these are essentially amounts that are owed by the organization to others, or they're amounts that have been deferred for timing reasons. So simple examples are what we call creditors or trade payables. This is money that the organization owes to others for goods or services that they've received. So at the sort of lower part of the balance sheet, you'll typically see, or you'll always see, what's called the net assets. So the net assets is simply the total assets minus the total liabilities. And now typically that number should be a positive number and it's an asset. But occasionally it might be a negative number, which indicates that the company's unfortunately got more liabilities than assets, which is normally an indicator, or possibly an indicator of not such a good financial position. Another calculation that people often do, which doesn't actually appear in the accounts, but you can calculate it yourself, is to look at the net current assets. So I mentioned that in some sets of accounts, you'll see the split of assets and liabilities between current and non-current. So if you just focus on the current totals, you take the current assets and you minus away the current liabilities, that gives you the net current assets. So that's quite an important ratio because it looks at the availability of assets that can be easily used to pay liabilities of the company. So if those current liabilities exceed the assets, there's a bit of an issue that the company might struggle to pay its debts, and that can sometimes point to a potential solvency type issue. And then at the absolute bottom of the balance sheet, then there's what's called equity. So the balance for equity will always equal to the net assets. And that's why this is called a balance sheet. The reason it balances is that those two numbers should be equal, or they always will be equal, you would hope. That's the whole point of a balance sheet. So that's the concept. And equity is typically broken down into different categories, which might include share capital, if it's a company that has share capital, or otherwise things like reserves and retained earnings. So moving on to the cash flow statement. So the cash flow statement, similar to the P&L, covers a period of time. So it covers the year to 30 June 2019, in the case of the one that's on screen at the moment. And it shows quite simply the cash inflows and outflows of the company for that particular year. And it's typically split into three different types of cash flows. So there's the operating cash flows, investing cash flows, and financing cash flows. So operating cash flows are those cash flows that relate to what the organization actually does, I suppose is one way to describe it. So in this case, for the Australia Council for the Arts, you can see if you're looking at the screen there's appropriation income of about $200 million, and there's grants expend or cash outflows of about $205 million. So, you would see from this that one of the main functions of the Australia Council for the Arts is to collect funds from government and then give those out to organizations through grants or other programs, and that's its operating cash flows. So you've then got investing cash flows, which are, in this example on screen, the organization has used some of its funds to purchase property, plant, and equipment. And then you've got financing cash flows, which often relate to things like the either receipt of funds from taking out borrowings or the repayment of borrowings, those types of financing activities. So it's important to point out that the profit and loss and the cash flow figures don't necessarily match up. So people often think that, well, if the company makes a profit, that means that it's generated positive cash inflows. Now that's possible, but not always the case. The reason for this is that some of the balances that go through the profit and loss statement that I spoke to before are non-cash accounting entries. So take a simple example, say an organization decides that it needs to purchase a vehicle, a van for some reason, for what it does, and it goes and spends $10,000 purchasing this vehicle, which it intends to use for, say, the next 5 years. The cash outflow for purchasing that vehicle will happen in the first year. So the cash flow statement will show a negative cash outflows of $10,000. But the actual cost of that vehicle, the expense that goes through the profit and loss actually happens gradually. So the vehicle itself is an asset. it sits on the balance sheet as within property, plant and equipment as a non-current asset, and it gets what we call depreciated. So the $10,000 value of that vehicle gets gradually written down. So say if it's a 5-year life on a $10,000 asset, it would be $2,000 per year reduction. So that $2,000 comes off the value of the vehicle and it goes into the profit and loss statement as an expenditure called depreciation. So that's just one example of how you can have a big lump going through the cash flow one year, but actually gradually spread out through the P&L in other years. So profit and loss and cash flows are not necessarily the same. That's the sort of takeaway from that. And then towards the end of the cash flow statement, you'll essentially see the sum of those 3 main category totals. So the total operating, investing, and financing cash inflow or outflow, whichever one they are added together, and that tells you the total amount of cash that the entity either received or spent during the year. And it will also show you the opening balance from the prior year, the inflow or outflow for the year, and then therefore your closing cash balance for the year, which should agree to what you've got in your balance sheet. So then just moving on to the notes to the accounts. So there's a lot of notes. I can't show you everything, but I've just got on screen what is normally the sort of first note you see when you flick past the primary statements. So we've got the objectives of the council on screen, and it mentions there, for example, that the Australia Council for the Arts is a not-for-profit entity, and it also mentions the legislation that it is governed under, and it mentions that these are general purpose financial statements. So I mentioned before, you've got general purpose or special purpose. In this case, they're general purpose financial statements, and therefore they comply with all of the accounting standards. It also mentions here that the accounts are prepared on an accruals basis. So I just wanted to explain the difference here. There's 2 main sort of ways that accounts can get prepared. One is a cash basis of accounting and the other one is an accruals basis of accounting. So a cash basis of accounting is a quite simplistic way of preparing a set of accounts, and it's often used by smaller organizations and potentially those that don't have to do sort of proper financial reporting or detailed financial reporting. And quite simply, it means that income and expenditure gets recognized as and when the cash comes into and out of the bank account. So it's quite simple. Now, that's not necessarily the most accurate way to prepare a set of accounts. So when accounts are prepared under accounting standards, they're prepared on an accruals basis. So when you're preparing accounts under the accruals basis, income and expenditure is recognized in the period to which it actually relates. So I've put a couple of examples at the bottom of the screen. So let's say we're looking at a company that's got a year end of 30 June 2020, and they've received services from a contractor that were provided in May and June of 2020. So in the year that's being prepared, the accounts are being prepared for, but the invoice for those services was not received until July, and therefore it wasn't paid until July 2020. So again, as I mentioned with your cash flow statement, your actual cash outflow is in the following year, but for the purposes of your profit and loss statement, the actual services you received were in the current year. They were in May and June of 2020. So it would be right to recognize those expenses in that current year to make your profit and loss statement as accurate as it can be. And because that's when you receive the services and therefore when you would expect to recognize the expense. So that's effectively what accruals accounting is. What you would do in that instance is you would actually put that expense into your profit and loss statement, and you'd recognize a liability, which is called an accrual, for the fact that you're waiting for an invoice to come in from this contractor. Similarly, if you take insurance as an example, insurance is often paid annually in advance by some organizations. So let's say you received your insurance renewal statement in June 2020 and you paid it then, but it actually relates to the period 1 July 2020 to 30 June 2021. So you've actually paid for it in the current year, but you're not going to receive any of the benefit of that insurance until the following year. So in that instance, you actually don't recognize the expense, even though you've incurred the cash this year. You actually recognize what's called a prepayment. So you take that expense out and you put it onto your balance sheet as an asset called a prepayment. And then only in the following year, when you get the benefit of the insurance, do you actually recognize the expense through your profit and loss statement. So then moving on to audit and review reports. So I haven't put the whole audit report up here because it's typically a sort of 3 to 5 page document these days. So I've just extracted the opinion section of the audit report here, which is up on screen. So an audit report is effectively, the auditor is an independent person or organization that comes in and checks the financial statements. So preparers of financial statements potentially have incentives to not display things in accordance with the accounting standards. So especially say a listed company, there might be an incentive to boost up their revenue or boost up their profits to boost the share price. So the job of the auditor is effectively to perform review and scrutiny and testing of the financial figures that appear in the financial statements, and then to give an opinion as to whether they are presented fairly or materially presented, so that the user of the accounts, the person reading them, can have confidence that they're accurate. So just to draw a distinction, an audit is what you probably most commonly come across, and an audit gives a greater level of assurance than a review. And what that means is the statement that the auditor makes in their opinion will use words like these financial statements present fairly or give a true and fair view. So it's quite a positive level of assurance that the accounts are materially accurate. And companies that have audits will be sort of larger companies, listed companies, public sector companies, and some other large private companies or not-for-profits. But some other organizations can have what's called a review. So a review is a kind of lighter touch, lower level version of an audit. It's not as detailed. The auditor doesn't do as much work, and therefore the opinion is not as explicit. So it will say something along the lines of nothing came to our attention, as opposed to saying that the numbers are true and fair or present fairly. So I guess when you're looking at a set of financial statements, it's good to see whether there was an audit or a review performed. And if there was, it's worth flicking to the opinion section of the audit report, which is where you can see what the auditor has done. And the whole report outlines the sort of scope of their work and whether or not, in their opinion, the accounts present fairly or true and fair. Or if they don't, there'll be a statement to the contrary, which you can read. So given the time limitation here, I obviously can't go through financial statements in a huge amount of detail. So I've just put a couple of resources up here that you might want to refer to. So the first one on the screen is a guide to understanding annual reports, actually for listed companies. It's designed based on reading listed company accounts. But the reason I put that up there is it focuses quite heavily on the sort of financial reporting aspect. So the primary statements that we've spoken about, it also talks to the notes to the accounts, the audit report, but in a lot more detail than I've been able to cover. And that document was co-authored by me on behalf of HLB Mann Judd, along with CPA Australia, one of the professional accounting bodies. And the second document on screen and link there is to a similar document, also between HLB Mann Judd and CPA Australia, although I wasn't involved in writing this one, but it's aimed specifically at not-for-profit organizations. Now, it doesn't go into quite as much detail on the financial statement side of things, but it's got some really good information around things like the types of entities that you get in a not-for-profit space, the governance requirements, the different regulations in the different states around Australia, and that kind of information. So if you're interested to know a little bit more, I would encourage you to have a look at those documents. So just finally to recap on what I've covered, a few of the sort of key takeaways. So I mentioned the different names for financial statements. So the annual report is that full glossy document with all sorts of other information, but also including the financial statements. And then the other terms you'll often hear used are financial report, financial statements, or just accounts. I mean, accounts might be the financial statements, but that's a very loose term. It could mean you know, an Excel spreadsheet with some numbers in it. It could mean a whole range of different things. But often when people say accounts, this is the financial statements is what they're referring to. And we looked at the profit and loss or income statement. And I mentioned that that shows you the income and expenditure of an organization over a period of time, typically 1 year. And I gave that analogy of it being like a video, as opposed to the balance sheet, also known as the statement of financial position. That shows you the assets and liabilities of an organization at a particular point in time, like a photo. We also looked at the cash flow statement, which shows you the cash inflows and outflows. Again, similar to the profit and loss, that's over a period of time, normally 1 year. We spoke about the notes to the financial statements, which tell you the basis on which they were prepared. So general purpose, special purpose, the legislation that they're prepared under. And then there's all sorts of notes that break down the numbers in the primary statements into more detail. I spoke about accruals versus cash accounting, and then the importance of an audit or a review report in a set of financial statements. So that's really it from me. I realized that was a very quick session, and it's very hard to get across a lot of information in that time. So I really just tried to pick out some core areas for you. But if any of you are dealing with financial statements in your role in a more detailed level, and you need assistance, whether it's with audit or sort of technical accounting knowledge, my contact details are there on screen, and you're very welcome to contact me.
Right, fantastic. Thank you so much, Michael. And we'll make sure that when we distribute the recording, we include those resource links and the information shared today. So it was really great to take a moment to learn some of these new and to revise some of these skills. So if you're okay, we might just ask you a couple of questions. Mm-hmm. And for everyone joining us today, feel free to send any questions you might have for Michael. Michael, I was thinking if we could maybe start, you earlier referred to reserves and of course for not-for-profit arts organizations, we sometimes talk a lot about the reserves ratio and what is a good reserves ratio, or just generally how much reserves do we need is a question that I hear regularly from arts managers. What's your response to that? Can you give us some guidance around, is there a formula? Is there a set sort of thing that we should aim for?
Yeah, it's a good question. Look, there's not a set formula because obviously every organization is different and has its own needs. I mean, I guess in a perfect world, every organization holds a buffer of reserves, if you like, for a rainy day. And, you know, coronavirus has just shown us what that rainy day could look like in a sort of worst case scenario, I suppose. Yeah, it's a really difficult one because depending on the type of organization you are as well, people can look at the accounts and see that if you're holding on to too much reserves, there's kind of a question as to, why have you got so much income coming in? You've got these reserves, why don't you use them? And you've got to strike that balance between, holding on to what you need to reinvest in the organization or to, meet your cash flow requirements and everything. So yeah, unfortunately, I can't give you a perfect answer to that. I think it's just a case by case basis, unfortunately.
But reserves are good.
Yeah, of course. And I mentioned about how we use the term in sort of not-for-profit land of surplus and deficit as opposed to profit and loss. And I think that's to try and get people's mindset away from this concept of profit, because whilst we don't use the term profit, surplus is really important, if possible, for not-for-profit organizations. That's showing that you're a sustainable business, hopefully going forward. And that's how you can build up those reserves and that buffer to ensure the longevity of the organization, hopefully.
So without maybe, because I suspect that this might be quite a complex situation, but I'm sure it is something that you've been thinking about, thinking about the not-for-profit accounting. What are some of the major implications of COVID that is affecting the way that we might have to prepare or read accounting reports and so on? I'm sure there is so much implications, but can you sort of maybe draw on some of the key principles that we need to either go and learn more about or know about that what
Sure.
COVID is impacting?
Yeah, there are so many impacts from COVID on financial reports of not-for-profits or any other type of organization. Yeah, almost too many to mention, but I guess some of the core ones would be around, I didn't talk to it in the presentation, but the concept of going concern. So financial statements are normally prepared on what we call the going concern basis. And essentially that means that they're prepared on the assumption that the organization will continue into the future, kind of operating and trading in its normal way. And so if a company runs into financial difficulty, that's when potentially it's no longer a going concern, or there might be a bit of a question mark about whether it is or isn't. And when you change your basis of preparation from the going concern basis to something else, it potentially impacts on the values of some of your assets and liabilities in your balance sheet. So for example, things like property, plant and equipment, those type of assets that you hold, their value is kind of based on the fact that the company will continue to do what it does and therefore get the benefit of those. But if, for example, the company is running into trouble or the organization is running into trouble and won't be able to operate in a normal way, it's possible that certain assets would have to be written down in value, what we call an impairment. So that can happen to things like physical assets like property, plant and equipment, or similarly to, if you've got investments, for example, the values of those investments might reduce as a result of COVID, because, if you've got shares in a listed company, their value changes in accordance with the value on the stock market. But if you've got an investment in a private company where you can't really go and just see what the share price is, it's quite hard to know what the value of that investment is. And you have to somehow come up with a valuation, which in the current time is a very difficult thing to do. So yeah, that's probably one of the major ones, but I mean, there's a whole host of problems. Cash flow forecasting is another one. I mean, depending on what type of area you're operating in, like in the arts sector, for example, trying to forecast your cash flows, if you're an arts entity that runs, concerts or events or something of that nature, at what point in time do you decide that you're going to be able to have people coming back, filling venues and buying tickets? And if you're in Victoria like I am, it's probably an even longer time, but it's very hard to make those predictions. So there's a lot of uncertainty out there as well.
Maybe what's your advice if you were an arts manager running an arts organization? How would you approach your accounting and finances at the moment? What's the advice that you would give people?
So if we're looking at the sort of forecasting side of it, which I guess is quite important to people at the moment, I mean, one tip is obviously try and be as realistic as you can. Obviously, there's not much benefit in being very aggressive in the assumptions that you put in deciding on what your future cash flows will be. Another idea is perhaps doing a bit of scenario analysis. So rather than just preparing one budget, I mean, you probably want to prepare one which is your very best estimate, but what you might want to have is some alternatives. So, what if the restrictions, the COVID restrictions get reimposed in other states around Australia? How is that going to affect our cash flows? Or if things improve faster than we expect, how will that change our cash flows? So just doing a few scenarios, and it lets you see, if you are a bit short on cash or you're going to struggle, where those pinch points might be and what might have to happen for you to get into a position that makes that a little bit more difficult for you.
Okay, I think we've got a time for maybe one more question, Michael. This sort of relates to something that I always sometimes struggle with as well, is the accounting for grants. So in a scenario, let's say I get a grant from the Australia Council, or let's say from Creative Victoria or from my local council, and I receive the grant, let's say on the 1st of June. So that's before the financial year end, but the activity is only happening, let's say in August or later on in the year. How does that work? When is that appearing in the financial statements in the year that we've received the grant, or the year that we actually expend the grant?
Yeah, that's a really good question. This is something I help a lot of not-for-profits with, this particular topic. I've literally run a webinar before on this, which went for an hour. But to answer your question, it's very, very hard in a short space of time. So the first thing I'll say is there is actually a shortened version of the webinar I did. I think it's about 12 minutes, and it's on our HLB YouTube channel.
Okay.
So perhaps I can give you the link and you could share it around, or at least share it with the person who asked the question, because you can watch that short video which explains it. It's a bit more technical than this session. They'll go into sort of a bit more of the terminology, but basically it's there are two accounting standards. They're both new this year for not-for-profits, and it depends which one of those accounting standards you fall in as to whether you recognize the revenue straight away when you get it, when the cash comes into your bank, or whether you actually have to defer it and you recognize it in the future years. Now, just really high level, the concept is what we call sufficiently specific performance obligations. So you get funding under a grant agreement. If that agreement has got very specific performance obligations that you need to meet, that is what allows you to defer the revenue and recognize it when you actually perform under, you know, the requirements of the funding agreement. Whereas if the funding agreement is quite general in nature, not overly specific, typically that will mean that you recognize the revenue straight away when you receive it. But it is quite complicated. So it's something we help a lot of clients with, because often the way grant funding agreements are written, or even grant applications, which do come into consideration there as well, that's the kind of way you can try and help yourself. If you are hoping to match your revenue up with your expenditure, you can often try and put a bit more detail into your funding applications and sort of help you meet the accounting standard requirement there.
Well, I think that is all the time we have for questions today. Michael, just a very big thank you again for joining us today. I know that this was a useful session to remind myself of, and I hope that everyone joining us today have learned something. So thank you again for joining us. We really appreciate it. Before we go, just a quick reminder, everyone, that we've got a couple of really great sessions ahead on Friday. Please join us at 11 a.m. for a session with Kate Larson, who will be exploring our hybrid future, really unpacking and guiding us through a flexible and remote online working, which I'm sure we're all grappling with and exploring. So it will hopefully be a useful session to join. And next Wednesday, please join us and our guest, George Liakos from Spark Strategy, to do a bit of a deep diving around strategy work, particularly in the environment that we find ourselves in at the moment. So I really encourage you to join us for both. So thanks for all for joining us again, and for sharing your thoughts and experiences with each other. And thank you again, Michael, for your insightful and useful session. And thanks for the Auslan interpreters today. We look forward to seeing you all next time. Goodbye.
Bye.